Alright, I'm here to give a brief economic update. Before I start, we have to go through the obligatory legal disclaimer that the information I'm about to provide you is general in nature. It does not take into account your individual needs and circumstances, so you shouldn't act on any of the information that I provide you today without first accessing professional advice, because it might not be suitable for you. And I guess where do we start? Well, I probably don't need to tell anybody here about the economic clouds that are appearing on the horizon. I think everybody can see it when they're going to the grocery store, going to the shops, and certainly when you're picking up the paper every day, that we have an inflation problem. So this has come out of the pandemic as prices soared. Central banks thought this would be temporary, so they didn't jump on it, and now they're chasing it and trying to get it on top of it, and inflation is certainly running away. So this is American inflation, so a little bit worse than ours, but the problem is global. So Australia is certainly not immune, and I'm sure you would have all been seeing in the paper recently. I think ours annual inflation hit 6.8%, so the very highest that we've seen in a very long time. But other advanced economies like the US and the UK are certainly dealing with the same problem, and it's happening in emerging markets. It's happening pretty much all around the world. So as a result of that, interest rates are rising. Central banks, their number one remit is to always keep on top of inflation, because spiraling inflation is the thing that erodes people's standard of living the most. So using monetary policy to bring down inflation is a bit like using a sledgehammer to crack a walnut, but it is the only tool really that they have available to them. So we've seen central banks commit to very aggressive monetary tightening and basically saying they will do whatever it takes to bring inflation under control, and that is appropriate. So I put this graph up here. So this is what's happening in Australia. Now this is actually, if you look at the figures, it's actually a couple of months old, so it's a little bit out of date, but I put it up there because I think it's very relevant. The top one shows where the interest rate has gone in a very steep curve in a very short pace of time, and that's what makes the papers, and that's what gets everybody really alarmed. But I put that up there because, as you can see by the bottom one, and obviously this is a bit high now because with the RBA hitting us up with 25 basis points yesterday as opposed to the 50 basis points that was expected, we're now sitting at 2.6% as the cash rate. But I put that up there because the bottom one shows you where these interest rate rises have come relative to the past and where interest rates have gone over recent years and decades. So while interest rates are rising, and that is of a concern, and that's going to put downward pressure on asset prices, you can see that interest rates historically are still at very, very low levels. I think that we are getting into a tightening monetary environment, and that's going to continue. I think we're going to see at least another couple of 25 base point rises in the cash rate to get up to about 3.1, and then the RBA is likely to take its foot off the pedal and just sit back and wait for that to flow through the economy. But it does just give us some relativity as to where we've come from in recent times. Now, rising interest rates is a problem if you carry a lot of debt. Now, unfortunately, the world carries a lot of debt. Ever since the GFC, we've been pretty much kicking the can down the road, and we've extended bull markets and raging asset prices by just fueling up on debt. So in some places in the world that's corporate debt, in some places in the world that is government debt, in Australia it's household debt. So you can see on the right hand side housing loan commitments. So in Australia the problem is household debt, which is well in excess of 100% of GDP. If you look on the left hand one, it's probably a little bit hard to see, but the orange line, that's central bank assets. The orange line is the RBA. The grey shaded area is the US Fed. Now you might look at them and think, oh, they're at the same level, but what you can't see is the axis. This side is billions, that side is trillions. So it gives you a bit of an idea of where the US Fed is sitting relative to the RBA. So why our debt is high on a dollar perspective, as a percentage of GDP, it's actually nowhere near where we're seeing other countries. So this means the bears are back. You're probably hearing this in the media, that it's likely we're going to see a bear market. From our point of view in our investment committee, that's probably our base case, that over a bull market that's now been artificially extended and gone on for 12 to 13 years, we think a 1 to 2 year bear market is now a base case. So there's a range of bear markets there. You can see that the average is a decline of around 28.7%. Recent one here that we saw in COVID in the green was obviously a very sharp decline, but then a very rapid recovery. Asset prices are falling. Now these again a couple of months old, so the probably downward leg is a little bit further than where it is now. But I put it there so you can see relative to the length and the extent of the bull market that we have enjoyed. So now seeing asset prices come off is not surprising, and we've seen this happen in the past. Recessionary signs are emerging. So on the left hand side you can see the US yield curve, and that is inverting. An inverting yield curve is a very strong sign of recession. So probably about 80 to 85% of recessions in the US have been preceded by an inverted yield curve. Now essentially what that means is that 10-year interest rates are lower than 2-year interest rates. So the market is factoring in that there's going to be recessionary conditions ahead and it will require monetary easing. Now, if you look in Australia, we don't have an inverted yield curve. So that would mean that the market in Australia at the moment is currently not pricing in a recession. Okay, so if we do have a bear market, when will the correction be over? When will we know? When we get to the bottom? Okay, well, as we often say to clients, no one will ring a bell. No one's going to tell us when we hit the bottom. Okay, nothing goes down in a straight line. So this is the bear market of the tech wreck, which started in around February, April 2000. And you can see from peak to trough, the market declined 48%. But over that time, there were rallies in the market, here and here. And there were various times that I think investors would have been buoyed, see the market go up and go, oh great, we're back to another bull market. And they would have bought into it, only to be disappointed and see the market sell down and fall further. So where will the bottom be? Well, to be honest, nobody knows. We only know when we see it in the rear vision mirror. So we only know once we're actually past it. And what you actually need from a technical analysis perspective, you need the market to find a bottom, to find a base or a level of support, and you'll see it finds a resistance level. When it breaks out above that resistance level and finds a new level of support, that is where we're into the next bull market. Okay, so if we're to look at the overall market and say, well, you know, are there some bullish signs? Are there some bearish signs? And what should we be focusing on? So let's look at the bull case first of all. What could we actually think of that could actually turn the situation around now and see us re-emerge into another bullish trend and see asset prices inflating again? Well, the first one is that the new government is going to release a budget in October. So there's always the opportunity of fiscal stimulus being provided by the government. I think at the moment, the rhetoric that's coming out of the government is that they intend on being pretty fiscally conservative. And Jim Chalmers is echoing that a lot. So I really can't see them coming out with a wide range of fiscal stimulus. There might be a little bit around the edges, but I can't see massive cash handouts or anything like we saw during COVID, because the government is saying that they want to keep debt under control, they want to get the deficit back under control. They do have about an extra 50 billion in their back pocket that they weren't anticipating that they could utilise, and we might see that go towards infrastructure spending and things like that. But I think cash handouts and really just broad-based stimulus is unlikely, and of course it would only add to inflationary pressures. So it would actually only make the situation worse. The second scenario that we could see unfolding is an end of lockdowns in China. Yes, they're still having lockdowns, and them providing stimulus to their economy, because as we know, China has been the big driver of global growth for many years. However, China has some structural problems. It has problems with its property sector, and it also has some weakness in its currency. So I think it's unlikely that we're going to see that significant stimulus, and if we do, I don't think it's going to be enough to drive global growth or to turn things around globally. The third one would be to see a major fall in energy prices. So that's going to be predicated on Mr. Putin pulling out of the Ukraine, or Mr. Putin falling over and dying, or him having a major defeat on the battlefield or something like that. But I think that what we've seen, he's there, he's embedded, he's there for the long haul. Any withdrawal out of Ukraine could likely see the end of his regime. The longer he stays in there, the more it plays into his hands, the more pressure that will perhaps be put on Ukraine to come to some sort of settlement, given that he's pretty much holding the most of Europe and a lot of the world to ransom. So I wouldn't be putting a lot of money on that happening. It could happen, and if it does happen, it will inject a lot of stimulus into the economy. So that would be good. The fourth one that I've got there is the base case. So what's more likely to be the catalyst for another bull market or the market turning around is peak interest rates, falling inflation, and lower stock valuations. So markets coming down further, inflation peaking and coming off, and that allowing central banks to stop rising interest rates, and then flowing through to the last part, which is monetary easing. Maybe they'll start to cut rates on the way down to soften the landing for the economy, and that would be the starting point for the market to reach a bottom and start to resume a bull trend. So on the bear case, well, what have we got on the horizon with the bear case? We've got an energy crisis, we've got higher interest rates, we have weaker growth, we have stubbornly high inflation, we have things like the UK tax cuts, and I know that now looks as though the UK government's going to sort of backtrack from that. We have a new Italian government, which is very right-wing. They're probably going to pursue lower immigration and a weaker currency. That will rise the spectre of the old pigs economies. Do everyone remember, cast their mind back to 2011, 2012, when we saw the sovereign debt crisis in Europe? Italy is the third largest economy in Europe. It's also heavily indebted. Bond yields recently reaching 4.7%. So this is going to raise the concern about sovereign debt default and sovereign debt issues in Europe. In Asia, as I said, China has property issues, and we're seeing a weakening yuan and a weakening yen in Japan as well. That's going to require both the Chinese and Japanese government to intervene in their own currency markets. And we've got geopolitical risks, particularly in Ukraine, also with Taiwan, Xi Jinping potentially flexing his muscles and pursuing some territorial ambitions there. And domestically, we've got falling house prices. That's only just started to happen, but as interest rates continue to go up, we're likely to see that happen further. So when you really look on both sides of it, I guess there's more evidence at the moment for a bear case than there is for a bull case. So are we headed for a recession? This is the big point that I guess everybody is really hanging on everybody's mind. If we have a bit of a bear market, is it actually followed by a recession? Well, the first thing is, what is a recession? Well, it's 2 consecutive quarters of negative growth. You can have 2 consecutive quarters of negative growth come and go, and you'd blink and you'd miss it. You wouldn't necessarily see a destruction of personal wealth. You wouldn't necessarily see massive unemployment or anything like that. So it's not so much about whether we see a recession, it's what is the depth and what is the length of the recession. The US is likely already in recession. I think that's pretty much widely held view, and the risk of recession in Europe is certainly growing, and I would think is in the UK it's probably highly likely, and in other parts of Europe it's certainly more than 50%. General consensus of most economists, the risk of recession in Australia is probably less than 50% at this time. So Australia remains somewhat insulated, but not immune. Okay, now this table is probably a little bit hard to read. The first table, and this is based on US data because they've incurred more recessions than we have, so it's more relevant data. The top one talks about stock returns during recessions. You can see that the green numbers are positive returns. What it's basically saying is that not every recession actually automatically generates negative returns in equity markets. So we could actually see positive returns during recession. It's not necessarily a one-to-one correlation. The bottom chart is showing that markets bottom before the recession officially ends. And right on the very right hand side there's some single numbers there, and what it shows is the number of months that the market rallied before the recession actually ended. And the average is about 6 months. So the market will rally on average about 6 months before the recession even ends. So to demonstrate that in a sort of a graphical context, bull markets last longer than bear markets. So we've seen, in the blue here, you can see bull markets across the S&P 500. In the orange, you can see the short, sharp bear markets, and the shaded areas are recessions. Over on the far right, I think if you take this one out, because it was a tiny little drop that we saw at the beginning of COVID, you can really add these two bull markets together, and I think that's where I get the figure of a bull market that's gone for around 12 to 13 years. So the average bull market is around 6 to 8, maybe 10 years. So the one that we've had has certainly been artificially propelled. The average bear market lasts generally about 12 to 18 months. So bull markets are generally longer and more sustainable. Bear markets are short, sharp, and then set us up for the next bull market. So what are we doing at the moment? How are we focused? Well, the first thing we're doing is we're being prepared. We are accepting the fact that the market environment has shifted, that it has changed from where it was 6 months ago or 12 months ago. We are cautious on the earnings outlook. So recent earnings reporting season in August was quite robust, but we think that rising interest rates and rising energy prices haven't really flowed through to earnings yet, so we are cautious on the earnings outlook. We prefer exposure to quality defensive, so whether that be in fixed interest, Australian equities, or international equities, we prefer to focus on assets that have strong defensive qualities. So this then begs the question, why not just jump ship? Why not take assets out of growth markets and put them into fixed interest markets, wait till the market bottoms, and then put the money back? Okay, we would avoid the temptation to switch completely to income assets to ride it out, because it is impossible to know when growth assets will recover. As I said, lower inflation monetary easing will be the catalyst, but expect markets to rally in anticipation. So by the time you're reading in the paper that we're in better times, the market has already shifted. And if you're sitting in cash, you're going to get left behind. The other factor is many growth assets provide solid income through a bear market. So even if you're holding on to shares, particularly in Australia where shares pay much higher dividends than they do internationally, you're getting good dividends and often getting good franking credits as well. So that keeps income flowing in while you're waiting for growth to return. The last point is that bear markets can provide good buying opportunities for investors with a longer term view. So if you believe that the bear market's going to last 12 to 18 months and you've got a 3 to 5 year investment time horizon, then this might create some buying opportunities to pick up some assets at good prices that will perform better over the longer term. So what are we looking at the moment? Well, the first thing is a move to quality approach, as I mentioned. So wanting to hold high quality assets. The second thing is a bias to developed over emerging markets. And that's because of sovereign risk and essentially the risk-return trade-off we think favours developed markets over emerging markets. We have a bias to Australia over global because of the high yield. As I mentioned, Australian equities generally pay higher dividends than international stocks, and the lower sovereign risk. Because our debt, our government debt in Australia is much lower as a percentage of GDP than other countries, the risk of sovereign debt default in Australia is extremely low. We have a bias to large cap over small cap because the simple fact is, in a recessionary environment, you want balance sheet strength. But essentially, larger companies have the ability to weather the storm better than smaller companies. We have a bias to investment grade credit if we're looking in fixed interest, so sort of BBB and above. If you look at that ranking of credit, you don't want to be down the bottom because they're the ones that are more likely to default. We also advocate focusing on total return when chasing income. Now, we talk about this all the time with clients, and it's as relevant in a bear market as it is in a bull market. Essentially, if you're looking at chasing income, you've got to factor in what's going to be the likely capital return as well. And you've got to be adding those together and looking at what the total return is, not just the income yield that you're going to generate over that time. There's some assets that pay very, very low income, but are still worthy to hold over this environment because the total return, when we allow for the capital appreciation, is good. or they might be very, very defensive in nature, so they're going to hold up well to a downturn. Okay, keep bank hybrid maturities reasonably short. Now, I mean, this is because if we see real carnage in the mortgage sector and then that flows through to the property market, the banks are very exposed and they only have provision for loan impairments of about 1% of their balance sheet. So if loan impairments were to get to 1.5, 1.7, 1.8, the banks will be forced to raise capital by APRA. And there's a few other ways that they'll do that. They'll cut dividends, they'll probably have share placements, share purchase plans and things like that. But they can force the conversion of hybrid securities into ordinary securities. Now obviously if they do that, it's going to dilute earnings, which is going to push bank share prices down, and the banks represent 25% of the market. So if that happens, that's going to push the whole market down. Take profits on fossil fuels at some point. So this is the only area of the market that's rallying at the moment. Look, it's good if you're holding those assets, but we don't have a positive long-term view on fossil fuels. So we would advocate clients taking profits during this time of strength. Reduce market exposure if appropriate. So I guess this reflects the situation where you've had a lot of balanced investors over periods of time as interest rates have got down to practically zero that were, say, 60-40, 60% growth, 40% income, and they've drifted towards 70-30, maybe 80-20. They've pushed money into the market to chase income. Now what we'd say is now's an appropriate time to take some profits and go back to 70-30, maybe even go back to 60-40, okay? Particularly if you're sitting on a fund which needs to fund liabilities. So if you're in pension phase and you need to make pension payments, you need to quarantine assets over here in order to get you through these times, because again, going back to the previous point, we don't know what the length and breadth of the bear market is going to be, or any recession that follows. So you want to make sure you're quarantining those assets so that you do not have to sell growth assets at a time in weak markets, because that's a recipe for disaster. The final point I put in there is cash is king. So a lot of people are adverse to holding cash because it doesn't generate a lot of return. In a market like this, we always say cash is king, essentially because it doesn't fall in value. It's a great store of value, and it can be instantly deployed to other assets when appropriate opportunities arise. So holding cash is good, and again, if you have liabilities to fund, then holding extra cash than you normally would will give you a buffer, allow you to put your head on the pillow at night and go to sleep knowing that you're not going to have to go into the market to sell assets to raise funds to fund liability. Okay, my final point is remain focused on the longer term. So despite the storm clouds that we're seeing appearing on the horizon, despite all the concerns about inflation, about interest rates, about bear markets, about declining wealth, about declining property prices and that, particularly when we look at shares, this comes straight off the ASX. Over the long term, the market will recover and it will post solid gains. So we're always talking to our clients about focus on the long term. Block out the noise, stick to your long-term strategy. If you're invested for 5, 10, 15 years, do not get too caught up in what the market's going to do in the next 12 months or the next 18 months. Make sure your strategy is sound, make sure you're invested into good quality assets that will recover afterwards, and continue to focus on the long term. Because markets have come through far worse times than these and eventually resume their long-term bull trend. And we don't see any reason why this situation will be any different. That concludes my presentation.